Well, it's fantastic to be here. As you heard, my name's Wayne Godwin. I'm the CEO for JLL in Africa. And I've got a few minutes, 15, to talk to you a little bit about what we're seeing across the world and across the region when it comes to real estate. Now, it's obviously not a lot of time, but we're going to sort of set the scene and I think follow on from some of the conversations that we've had earlier. So I think the first thing we wanted to talk about is sort of how are investors feeling. It's quite a crazy world, right, that we sort of find ourselves in. A lot of noise. How is the sentiment? So we track every quarter a survey globally of investors, and we ask a very simple question. How do they think the market will be in 6 months' time versus today? 3 options: improves, stays the same, or worsens. So we really sort of see how the sentiment is sort of tracking broader macro trends. And you can see last year far more positive sentiment than there was sort of negative. And now that's sort of turned a bit this year in Feb, shortly after the inauguration, et cetera, in the US, and some of those policies starting to come into effect. But if you look at the percentage of people that are positive, it's actually fairly similar to last year. In fact, higher than some of those quarters. It's really that sort of stay the same or worsen. But I think that's the sort of reality is we don't sort of know. It's quite an unprecedented set of circumstances where we find ourselves, a lot of geopolitical noise. We kind of have to take a step back from that, I think, and look at the sort of broader sort of fundamentals. And real estate's cyclical at the end of the day. So if we put aside some of that rhetoric and geopolitical noise, where are we in the cycle? And we can see that we are very much within the early stages of a very definite cycle, right? As JLL, we transact on about $1 billion of real estate every day. And of course, you get a number of bids alongside that that's unsuccessful. And so we track about $7 billion of real estate bids every day. And we're very sort of scientific around that. And we've developed this bid index, which you can see at the bottom there. And you can see that bid frequency index ticking up. So there's definitely more bidding activity on deals. And you can see the other blue line being the bid-ask spread. So that's showing the pricing is coming closer to par, right? Closer to where the asking price is. So certainly from a liquidity perspective, whether you look at it in absolute transaction volumes or participants in real estate globally, it's up. We're in a cycle, very definite. So what we sort of expected from this cycle is to be very concentrated by asset class. And actually, we're seeing it quite sort of spread and balanced across various asset classes. So that's the one sort of hallmark. The main hallmark of this cycle is that we all know, we're not headed back into that same very low cost of capital debt environment. We're just not, right? So returns are absolutely going to be premised and based on income growth. So we believe this is certainly a better hallmark for African real estate, where longer-term growth is required to get your returns. You can't rely on cheap cost of capital. So in the previous cycle, that's where returns were being made. So it's actually a good time to be in real estate. It's a good time to be a practitioner, someone whose role is about creating growth in an income from an asset perspective. That's what this cycle is going to be all about. And we certainly believe it does bode better for African real estate on the whole. So you can see that uptick in about 14% of investment volumes, but that bidding frequency and activity, that's even bigger, right? So we're in that cycle. We think it'll be gradual, and the broader rhetoric and that we're seeing from a trade war policy, etc., that's going to play out, of course. Bringing it closer to Africa and talk, because obviously it's a very small part of that global investment volume. And why? And I think we've touched on some of it already this morning, but we sort of see it from a supply and demand imbalance. And we're not talking about supply and demand of maybe offices on a particular street corner versus demand and whether there's sort of opportunity. I think a bit more holistically, the demand side, and it was great in Jeff's presentation, I think showed that, is actually a good story. I think an underrated sort of story when we look at the number of economies that have consistently been growing and the type of growth. The type of growth is important, and I'll touch on that a bit more now. But I think it's the supply side of the broader capital market side, bond yields high, low resilience from a capital markets perspective, and the rest of the world sneezes and we get sick. It's that the challenge, and higher construction costs, etc. So it's the efficiency for markets, for investors, versus the growth side that we feel is the main challenge. So why we're bullish from a growth point of view? I think we saw it from a GDP perspective, but GDP only tells a part of the story. That's the headline figure. Farming activity in sort of rural setting has very little influence on building value next door, right? It's what parts of the economy really correlate with real estate. We see city growth as a strong correlate, right? And that's a very good story. It's actually even a higher sort of growth factor. And no cities are growing faster from a GDP perspective than sub-Saharan Africa. It's that population dividend, urbanization impact, right? And where are cities growing fastest in sub-Saharan Africa? East Africa. So that's, from a growth perspective, a big factor. It's where else from an economy. It's the tertiary sector, the services sector. That matters. That's where high productivity rests. And we're seeing improvements decade on decade, year on year, etc. there. From a supply side, obviously bond yields are high, and you heard Samir talking. That's a competitor to capital. And while bond yields are high, it's sometimes difficult to attract investment from real estate. But they are coming down. But I think it's the broader sovereign risk profile that we sort of have that is the main factor inhibitor to real estate investment in Africa. So going forward, it's countries that develop sophisticated, robust capital markets are going to be far better opportunities and playgrounds for real estate investors. We touched on the interest rates, and yes, those will come down. We think, besides the sort of impact of trade wars, etc., markets are generally underestimating some of the price cuts, but we're very much seeing it in that sort of bidding activity, the expectation of price cuts. But from an Africa perspective, it's actually quite a mixed bag if you're not sort of able to tap into sort of dollar-based lending, right? A very big, broad mix of where sort of key and interest rates sort of sit. And outside of the sort of outliers of Nigeria, Zambia, and sort of Angola, which are sort of particularly high, a lot of the others, when you look at inflation, it's actually pretty benign. 3-4% in markets that are growing at 6-7%. There's a question as why are interest rates not sort of coming down faster? Hopefully they will. We saw those sort of forecasts in the ABSA presentation, but it's a lot to do, I guess, with the sovereign debt risk level that we sort of need to get these ratings agencies past, etc. And then I think the other big thing for investors is sort of transparency, right? As JLL, we've developed this GRETI index, so the Global Real Estate Transparency Index, and we look at about 89 different countries, and we track them on 7 broad metrics. Each metric has various sort of sub-categories, and we look at how transparent is a market to invest. It's not how is the market better or worse, it's how transparent is it? So from a sub-Saharan Africa perspective, you only really have South Africa in the transparent category. You have Kenya and Mauritius in the semi-transparent category, and then it sort of falls away into that low transparency and opaque setting, right? So one of the big sort of areas where a lot of the African countries fall short on is sustainability. Now, it's not to say that investment into Kenya is not sustainable. It's that global investors, are they able to measure the sustainability impact? Are they able to track it? Is it able to link it to tax, processes within the EU, et cetera, et cetera? So I think it's looking at these sort of indices and how do you improve transparency for that capital to come, together with more efficient supply side of our real estate markets. Sustainability, I think, is a very big one, right? And I think Samir touched on it a little bit around the flex sort of space, but certainly we see a sort of correlation. And in a market like this, there's very little sort of sustainable linked supply. But you can put aside all this sort of rhetoric from the US and sort of moving away from Paris climate change agreements, etc. Too many countries are too far along, and there's too many commitments that have been made, and certainly a lot of the occupier activity in this part of the world, the decisions come down from a European perspective. Europe is so far ahead when it comes to ESG that I think we've got to ready ourselves for more corporates and occupiers saying, you know, it's been fine to date to allow you to sort of occupy a non-sort of sustainable building, but we've got to kind of draw a line, and this is a zero, policy going forward. So I think there's definitely going to be far more pressure on the occupier side. It's not going to be sort of investor-led. It'll be occupiers, and that's how it's been everywhere else in the world, right? So that's going to be key. But you can see those green premiums coming in some of these sort of more sophisticated markets and very high levels of green stock. So I think we've got to make this a bigger talking point, because I think, you know, buildings that are occupied that do not have the right green credentials, 5, 6, 7 years time, it's going to be a lot more sort of the word obsolescence will come into a lot more people's vocabulary. Data centers, and I won't talk to it too much, but I think obviously we see it as a huge opportunity. If you look at the current sort of load and where it's sort of spread and the broader opportunity. But I think, and it was touched on earlier from a demographic perspective, you know, asset classes that are linked to that demographic growth story, right? 17% of the world's population today will be 25% by 2050. The assets that are linked to that demographic growth story, there's a strong underpin and story. Data centers is one of that. Everyone's a consumer of data, affordable housing, healthcare, anything that you can sort of tie to that demographic story is a strong one. You know, luxury residential maybe isn't. That might have its own thesis in its own market for its own good reasons. But that's really where we see sort of a strong opportunity going forward. And what I'd like to leave you on, and I think, thank you very much, and it's good to be back, and hopefully we have a good few days, and look forward to catching up with everyone in the room. So, yeah, thank you.